Hey, everybody. Welcome back to Fundraising for Startups. So today, what I'm going to walk you through is how to present and pitch your financial and growth model. This is something that generally happens in the second or third meeting with an angel investor or a VC. But don't be surprised if you get asked to show your model earlier than that. And you may even be asked to send it over email, which sometimes happens. So what you want to do is you want to go into these meetings with confidence and with ownership of your model, specifically around your revenue and or user growth metrics. Now, you're likely going to get a whole host of questions from investors. And ideally, those questions come in the form of a conversation along the way when you're presenting. If you're not getting any feedback from the investor while you're walking through your presentation, then it's likely they're lost. So make sure that you're checking in with them to ensure that they're tracking with what you're showing. If you get to the end and you get some questions, you're likely going to get those questions around how do you make money? What is your current subscription model? How are you currently getting customers? What's your growth rate been the last 3 or 4 months? Show me what your P&L looks like. Oh, I noticed your bank balance got pretty low. What happens if you don't successfully raise money fast enough? How big is your team? What's your head count? All of those things are going to become potential questions that you're going to need answers to. But the focus of today's session is really going to be about presenting your model in a clear and articulate manner. And I'm going to show you, again, the model that is based off of the one that we used for GrowthU, although it's got different metrics in place just to make it a little bit easier for examples. So I'm going to share my screen, and I'm going to take the stage as if I were presenting to an investor live, and I had this in front of them. So I will get into my script mode here in 1 second. Okay, hey, thanks, investor, for being here. And really why we're here, I know you had asked about seeing our financial and growth model. So what you're looking at in front of us here is that we've set a goal of $500,000 in revenue for year one. And based on our current traction and our current growth rate, which has hovered around 15 to 25% the last 4 months, we set a goal of that 500,000. Now, as you remember in our last conversation, our subscription costs $49 per month. And we have seen roughly 15 to 20% monthly churn from our subscriber base every month. And so that's annotated here, and I've built that into the model. In the first month that we got started, that I'm going to show this model based off of, we had 100 subscribers at that point that were in the mix with us. And our customer acquisition cost right now is hovering around $200. And the note about the customer acquisition cost, we've been running experiments in paid social as well as in paid search, and we've run a really successful referral-based campaign. And so our blended customer acquisition cost has hovered around $150 so far to date. I modeled the next 3-year plan off of a slightly higher customer acquisition cost as we get to scale. That's why you're seeing $200. So let me walk you through how this works. Our current MRR is around $4,900. And so that's what you're seeing in month one here. Now, we've applied a 20% monthly growth rate every single month moving forward here, which we believe is attainable based on historical data that we've had so far. And as I mentioned, the last 3 or 4 months, we've had a roughly 20 to 25% increase in growth every month. That means that in the next month, we have to bring in 120 new subscribers. And by the end of next month, we'll be around 205 total active subscribers. Again, using that 15% churn ratio, we believe we'll lose a handful of those customers every single month. Next month, we're going to be at that 10,000 mark, 15 after that, 21, 28, 36, and so on. And you can see that by the end of month 12, so at the end of this year, we will be at about $123,000 in monthly recurring revenue. Now, I know the last time we met, you had asked some questions around our marketing budget. And at the time we were spending anywhere from $10,000 to $20,000 a month on marketing. And we've got a team of 3, and our headcount total cost right now is $20,000. Now, one of the things that we're planning to do as we ramp up the model here is towards the end of this year and into next year, we're going to be adding additional headcount, and we're going to increase our marketing spend and our marketing budget as we go as well. We believe that when we get to the end of this year, and if we successfully raise this round, what you're likely going to see is that we'll have a headcount cost that goes up as early as month 2 or 3 or 4, depending on when we finalize all the paperwork on this round. One thing that's worth mentioning is that I added a bump in our bank balance here in month 9, because it's likely by that point we're going to raise a seed round. And you can see that currently we've got $350,000 in the bank. After this round, we anticipate we'll have close to $500,000. And I did not add this to our model yet because I'm not concerned with our bank balance. And in fact, if you look at our scratch P&L, our burn rate is kind of in the $35,000 a month range, which basically means that we don't run out of money as long as our funding state seems solid, which it is so far. Again, we're more than halfway committed on this deal. So as we track along here, we're going to look at healthy marketing budget growth. So we're going to aggressively grow this marketing budget as we acquire new customers. And again, the marketing budget is just a function of the customer acquisition cost times the number of new subscribers that were coming into the model. And again, by the end of the year, we'll be burning about $45,000 a month all in, including our headcount cost at that point and our marketing budget. And again, this model will likely shift as we add additional headcount and as we close this round and the next round of funding. So the key takeaways here are that in year 1, we've anticipated a projected revenue of almost $600,000 with a marketing budget of almost $800,000 with our $240,000 headcount cost. That's again with 3 full-time people and some contractors in the mix pre-round. We will pull about $435,000 out of the bank. You'll notice in year 2, we're gearing up, we're spending more on marketing, but our revenue hits that $5.5 to $6 million range, really where we'll start to hit scale at that point. And you can see at that point that our headcount cost goes up from there. And then as we venture out into year 3, you can see that we're really starting to hit kind of those, those 8-figure high 7 and low 8-figure revenue metrics as that growth starts to compound and as all of our acquisition channels kick into gear. And you can also see that we've increased our headcount costs as well along the way. So I'm just going to pause there. I'd love to open it up for any questions. Okay, so I'm coming out of script mode here. So that is how I would walk an investor through the model. Now, if I were on the investor side, I left a little bug in the code here for you all to look at. Take a look at this model and what isn't really adding up for you right now. There's a couple things. Year 3, do we really think we're going to get to 52 million in revenue? Okay, I don't think so. That is incredibly fast growth, and it's unlikely that we're going to get there. So the way to deal with this, and an associate or a VC in a meeting will probably find any of these issues that you have in your model. So rather than kind of panicking, if you do make an error, simply revisit the model and say, you know what? Yeah, you're absolutely right, Chris or Jen. Thanks for giving me your feedback. What I'm going to do is I'm just going to adjust down my monthly growth rate starting in year 2, and instead of 20% month over month growth, what I'll showcase here is a 15% monthly growth. And then starting in year 3, I'll move that to 10%. And I'll basically just show that for the rest of the time, anticipating that maybe growth slows down a little bit in year 2 and year 3. And that looks much more doable. So this model is built in a way that can let you kind of react on the fly. Hopefully you don't have to do that. I would catch these bugs as you go. This is why I think it's really important that you get feedback from friends and family and other potential investors and your team before you go and show this in a really high stakes meeting. But if you find yourself in that scenario, you see how I just kind of talked my way through it. That's the name of the game there. There's one other error here that I've kind of left in for you. And I kind of alluded to this when I was talking about the headcount cost, right? But if you notice here in column J, I did a big bump from $114,000 to $577,000. Now, what is that? Well, that's probably our seed round. Now, a savvy investor, when they are in a meeting like this with you, they're going to say, well, wait a minute, you raised 500,000, but your headcount cost isn't going up at all. Well, walk me through that. And so again, you're probably going to have more of this nailed down in advance. But if you get that type of hard question, you need to be able to maneuver through that. And you can say, Jen, Chad, thanks for that. That's a really great question. I didn't quite adjust my model to account for this new revenue. And in fact, what we think we're going to do is we think we're going to add probably $10,000 of new headcount in the first, call it 3 months. So we get up to $50,000 with some new hires. That brings us to a team of 8. And we're going to hold steady on that for a couple months. And then we're going to go up to 60 because we just hired 2 more people. Maybe we're extending our sales team. And you can kind of see what happens over time here as you build in that higher headcount. What's happening is it's changing your P&L in year 2, and it's also changing your P&L for year 3. So you've got a lot of different levers you can pull here. There's a lot of different ways you can model this out. I would go out as far as year 2 for your model. You can see that most of my errors happened either in year 1 around that headcount cost and that bank balance, or in year 3 when we've started to lose track of kind of what's likely to happen. So you may want to just run a year 1 and a year 2 model, but I like to include 3 in these spreadsheets just so that you kind of go through the exercise. And there are some investors that want to see that full 3-year projection, and even some that want to look at a 5-year. So if they ask for a 5-year, you probably can't really answer some of those questions on the fly. But what you can do is go back, revisit the model, and rebuild the model based on a 5-year projection, similar to what we had shown in this tab earlier, which again, your investors may or may not even see, depending on kind of what your relationship is with them. So that is the gist of how I would walk through the financial model. Your transactional model is going to be very similar, except you'll need to talk about new purchases and maybe repeatability of purchase at some future point in the model. If you're finding that in this case, your price per unit is $199 and you sell multiple units to one person over the course of 1, 2, or 3 years, you'll probably want to add a row and bake in something that's like average number of purchasers per user or some other metric that will let you get to a revenue number that might align more nicely with what's actually happening with that repeatability. So again, have confidence going in, expect questions. These models are not supposed to be flawless, especially early on. This is why you should probably talk to some friendly investors early on, get feedback. If you go through an accelerator, accelerators are great at looking at these models and giving you feedback. I've been in some fairly high stakes meetings around fundraising where the model is just off and wrong and the investor kind of gets rude. They ask questions that you think are really dumb, but maybe the investor just is actually confused, or maybe there's something glaringly wrong in your model, or it's not believable, or you don't showcase your model with conviction and the investor just doesn't quite trust the numbers. So I would urge you to just own this, be able to pretty much point to any spot here and speak to the metrics. So let's say the investor said, "Hey, Craig, I noticed in let's just fast forward to month 14 here. That's in 14 months from now. You've modeled this at a 15% growth rate. Tell me about how you get close to 1,000 new subscribers at that point." And then you have to answer, well, okay, well, thanks, Jen. Thanks, Chad. That's a great question. The 1,000 subscribers, the new subscribers that we're pulling in that month, we anticipate are going to come from 3 main sources. The first is an extension of what we've been doing with our paid acquisition. The second is that we believe our referral flywheel that we've built and that's running really nicely will continue to work well. And lastly, we've been investing heavily on SEO. And what we found is that there's a lot of intentionality with the users who search for our product. And so we're just getting started with that, but we believe in month 14 here, we're going to be seeing the benefits even earlier than that. But by month 14, we'll certainly be seeing the benefits where I don't want to say half, but a large percentage of our customers will be coming in from organic channels as well. So hopefully that answered your question. I'm happy to dive deeper if you'd like. So this is the name of the game at this point in time, is with conviction, being able to show the model and to be able to answer random questions that are going to be thrown at you from the associate, from the investor. Talk about your customer acquisition costs, talk about those channels, and put together a believable plan. And if 20% growth makes you nervous, then pick something that's a little bit more doable that you can explain why you chose that model. I've seen a lot of investors push back on too conservative of a model more than I've seen investors push back on too aggressive of a model. So please put your model together. And if you'd like to pitch me, you can book office hours with me. You can also feel free to just put a recording together, watch the recording of yourself going through this. Do what I did. Ask yourself some questions along the way. It's kind of silly to do it, but it really is a way to practice. Watch those recordings and then reach out to a peer at another startup or an investor that you know that's a friendly, and start to get this feedback before you really dig in and get into those second and third meetings where you're going to get asked a lot of really tough questions. Okay. Thank you so much for tuning in, and we'll be back soon.